Hello friends, a very warm welcome to my channel. In this video, we are going to talk about Ola Electric, which is a newly listed company in a very interesting space, which is EV vehicles manufacturing. So there is a lot of buzz about this company because it's a new age company making innovative products and growing very fast. And there have been contradictory views from different investors, and that's why the stock has also been very volatile since listing. So this is going to be a very interesting video. If you're new to the channel, please do subscribe and hit the bell icon. If you're not a part of our Telegram channel, do join today by clicking the link in the description so that you join the correct Telegram channel. Every day morning before the market opens, I share my views on the market and also share a lot of portfolio allocation strategies which will help you increase your portfolio returns. So let's talk about Ola Electric. This will be the flow of our discussion. We'll talk about the business model in brief. It's a very simple business. We'll see the stock price movement post listing. We'll see the financial performance of the company in the last 4-5 years because it's a newly formed company. We'll discuss why the stock has fallen post-listing. We'll discuss the outlook of the management going forward. We'll talk about the present valuations of the company. We'll understand the risks of investing in this company and then form an overall view. So Ola Electric is a company which was incorporated in 2017, but majorly it started operations in the last 3 years. It makes electric two-wheelers and is venturing into three-wheelers also, and also has backward integration and makes its own battery packs, motors and vehicle frames. In two-wheelers EV segment, it has 33% market share, which is a large share. It's a market leader in India, and the company does in-house manufacturing, so their manufacturing cost is low compared to its peers. The technology is also developed in-house, and they keep developing newer versions of the existing technology which will increase the efficiencies and reduce the cost and give a better experience to the users. They're also focusing on vertical integration. They will be making their own cell in-house, so they are setting up a gigafactory for cell manufacturing. So all these efforts will lead to a substantial growth in the company as well as increase in efficiencies going forward. If you look at the stock price movement post-listing, it had an IPO price of somewhere around 76 rupees, which made a high of somewhere around 150 to 160, and then fell sharply from there towards the 70 rupees zone. In fact, it went lower than the IPO price, and now it is consolidating sideways in the zone of somewhere around 80 rupees. So as you can see, the price has been very volatile because there are contradictory views about this company. Now we'll get clarity about that as we study this forward. In terms of revenue growth, the main operation started in FY22 with a turnover of somewhere around 370 crores, which went up to 2,600 crores in FY23 and about 5,000 crores in FY24. And in the trailing 12 months, it has delivered a revenue of about 5,900 crores. So in terms of revenue growth, it has been very impressive. Now coming to the profitability part, EBITDA, at the EBITDA level, the company is making losses continuously. It made a loss of somewhere around 277 crore in FY21, which increased to almost 1250 crores in FY23 and 24. But we see a small reduction in the losses at the EBITDA level, and it has done a loss of about 1000 crores in the trailing 12 months. Going forward, the company believes that this losses will further reduce as their margins increase. In terms of gross margin, we will not look at the EBITDA margin in this case because the EBITDA margin is negative. We'll talk about the gross margin. That is what the company is also talking about in their presentation. So in the last 5 quarters, this has been the gross margin pattern. Largely in the last 4 quarters, you see that it has improved from about 18% to 20%, and it is stabilizing around 20% in the last 2 quarters. Going forward with their version 3 of vehicles coming, the backward integration of cell manufacturing and the operating leverage kicking in as the company scales up its production, the company believes that this gross margin of 20% will rise to above 30% gradually. So this 10% will have a massive impact on the profitability of the company. Now, if you study the volumes compared to Q2 FY25, which was the recent result, the company sold about 98,000 vehicles, and the last year in the same time they sold about 56,000. So overall the volume has been very good. But if you look at the premium vehicles compared to last year, we see a reduction in the premium vehicles from 56,800 vehicles to 42,000 vehicles. So as they launched the mass segment vehicles, the mass segment picked up. They sold about 56,000 vehicles in the mass segment. But the premium also took a hit as people must have changed their mind and switched to the mass segment vehicle. But the company says that they earn similar margins in both the categories of vehicles, and the overall volumes is what the company is looking at. You will not see a steady Q on Q rise in the volumes every quarter because this is a little seasonal business. Promoter holding because of the several fundraisers has gone down to 36.8%, and if the company wants to scale further, wants to raise further funds, then this can further go down. They have a debt of about 3,300 crores but a cash of about 5,900 crores. So net debt wise it is debt free. Operating cash flow wise, it is still negative as the company is in the growth stage. So if they want to further scale up, they have to raise fresh funds after finishing the 6,000 crores of cash which they have. But as this product is sold after the payment from the customers and they follow a direct to customer kind of a model, eliminating all the distributors and dealers in between, their working capital is very well managed. So the only place where their money gets locked is in the inventory part because the sale is almost within immediate payment. Now, what is the reason for the fall in the stock after making such a high of 160 rupees? The company's growth on a lower base was very high, but as the base increases from 5,000 crores, the growth may slow down. That is a doubt in the minds of the investors. Profitability wise, the company is showing a path to profitability, but people still doubt whether that can be achieved or in how much time will that be achieved. And valuation wise, it is not a very cheap stock. So in fact, at 150, 160 levels, the valuations were very expensive, and that tend to be normalized now. What is the growth outlook of the management going forward? They want to focus on three things. One is increase their distribution network, improve efficiencies of production, and also launch a number of new products and increase their product portfolio. So at present, they have 782 stores, which they want to scale to 2000 by March 2025. These are company owned stores. They also have a network partner program. So somebody who's selling other brands can also sell Ola Electric. So that they have about 1000 stores right now. They will increase to almost 10,000 stores by the end of this year. The company believes that the electric two-wheeler penetration in India is at an inflection point, and from here it can drastically increase, which we also see. And the mass market products which they have launched, which are cheaper than the actual Ola electric vehicles earlier, they have also given a very good response to the company. As the company scales from the present 5,000 crores, the company believes operating leverage will kick in and the profitability and the margins will increase. And they are also venturing into other two-wheelers like motorcycles, which will be launching shortly. In terms of the number of vehicles or the variety of vehicles, also they have the highest in the industry in two-wheelers. We are starting a cell manufacturing plant in-house. So it's a gigafactory which will increase the margins of the company. In the next 2 years, they are going to launch 20 new vehicles. So every quarter, they are going to launch one new vehicle. Service-wise, their sale was faster than their service centers. So we saw a lot of issues in their servicing part. But now they have normalized that. And the company claims that all the more than 80 to 90% of the service requests have been handled in T+1 time. The promoter says that they can grow the company, or they aim to grow the company by 50% every year for the next few years. And the gross margins will increase from 20% to upwards of 30% gradually. So in terms of product portfolio, you can observe in scooters, they plan to launch various new models. They want to venture into motorcycles, and they're already working on electric two-wheelers as well. So this is how their gross margins will behave, is the management saying. They are doing about 21% now. So 20% additional savings will come from the Gen 3, which they are going to launch now, which is a newer technology. 7 to 8% will be contributed from the in-house cell manufacturing. The reduction of subsidies from the government will impact the margins by 12 to 15%. So the margins can stabilize around 34-35% going forward in the long run. Now coming to the valuation part, which is very interesting, and we are looking at this company from a very new perspective because we don't have much of history, and it's a loss-making company. So right now, in FY24, the company did a revenue of about 5,000 crores. Let us assume what the promoter is saying is correct, and the company grows in the next 3 years by 50% every year. So the revenue by FY27 will come to almost 16,875 crores. And let us assume that the gross margin improves from 20% to 30%, and it will do a gross profit of about 5,000 crores in FY27. Right now, the company is doing an operating expenses of about 500 crores, and the management says that the operating expenses will not rise much as the company scales going forward. So assuming that will more or less remain the same, the yearly operating expenses we assume to be around 2,000 crores. So reducing this 2,000 crores from 5,000 crores, we get a EBITDA of about 3,000 crores in 3 years from now. Now on this, if we apply an industry average of 15 times EV EBITDA, the market cap comes to about 45,000 crores. And if you want to be a little more optimistic and let us give it 20 times the EV EBITDA multiple, it comes to about 60,000 crores the market cap. So from the current market cap of 36,000, in the next 3 years, the company or the stock may see an upside of 26% from here at 15 times, and at 20 times may see a upside of 68%. We have to be very clear. There are several assumptions we are taking in this calculation. The first assumption is that the revenue will grow every year by 15% is what the company is aiming for, which may or may not happen. Second thing, we are considering margin expansion to up to 30%, which may be lesser or more than this. The third thing is the multiple what we are giving, so that even you as an investor have the flexibility to be pessimistic, optimistic. You can take a base case scenario or a bull case scenario and give different multiples. So these are subjective things, and we are taking some assumptions for the benefit of studying this company. So this is how, in one way, we can look at the valuations of this company, as it's a loss-making company. Now, what are the possible risks of investing in this company? The subsidies which the government is giving will soon be tapered off, so the people may take lesser interest in buying such vehicles. Profitability is always a question in this company. The management may or may not achieve the guidance which they are giving. There is increasing competition in this space from existing and new players. The company has to keep updating the technology and bring in newer versions. After sales service is a big risk, as the brand gets spoiled if the service is not proper after selling. And if the product has a lot of problems, the quality of the product will be in question, and the sales may fall drastically. So now that you've understood the business model of the company, the valuations, the growth prospects, the risk of investing, what is your view on the stock? So if you're a value investor, conservative investor, these kind of companies which are loss making, which have a lot of uncertainties in business may not suit your risk profile. But if you're an aggressive investor who wants to try out such things, who wants to take a risk, then you can consider investing in this company and closely monitor whether the management is achieving what they are guiding for, whether the company is moving in that direction in terms of revenue, margins, profitability. If that happens, then the growth in the share price will follow. That's about Ola Electric. This is a crisp video. I've tried to cover all the important points in this video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the stocks names in the comment section. Do join our Telegram channel by clicking the link in the description button. Thank you for watching and have a wonderful day.